It is Sunday, December, what is it, December 29th. We got two trading days left in the year. I've got a couple of talk shows, a couple of interviews to do with early in the week. These are just some of my notes. In the end, it always comes down to the same question, people. What's working, what didn't, and what's next? Welcome to the Money Runner. I'm David Nelson. You saw my post last week. I talked about targets and the futility of trying to come up with a target. I've done it in the past, and more often than not, it's wrong. If you go back to the start of this year, the average target by Wall Street strategists for the S&P 500 for 2024 was 48.33. We hit that level in 4 weeks. Right? The highest estimate was 5,200, and we hit that at the end of the first quarter. So the futility of coming up with a target, I think the only message that I get out of it is that markets are a living, breathing animal, and we have to adapt and change as the data comes in. You know, when the data changes, we need to change. You need to change. I need to change. All right. So let's talk about where we are for the start of this, final shortened trading week of the year as we go into the New Year's break. December, it's supposed to be one of those months where it's feel good, the market kind of drifts higher, and we obviously didn't get that. And I think for a lot of reasons. I think, we had a Federal Reserve decision that wasn't so much of a surprise for me, but it seemed to surprise the street. But bottom line is our expectations for rate cuts from now until maybe the first part of 2025 is certainly less. And Jay made that quite clear in his commentary. So whatever was priced in, it's something less than that. I think the consensus right now is about 2 cuts for 2025. Trust me, that will be adjusted as time goes on, as we get more data. If inflation pushes higher, we may not get any cuts. In fact, it's always possible we could get a hike. If in fact we start to get a lot of cuts, my guess is it's probably because of bad news. We're either seeing something pretty negative in the labor picture, or in fact that the economy is starting to turn down. That's what the Fed's role is. It's the dual mandate. But it matters because in the end, the risk-free rate matters because it is the first input of most valuation models. It doesn't mean that stocks can't go higher. In fact, they can, but it does mean that the hurdle rate is that much greater, and we're going to need to see an earnings move that's that much better. Now, the good news is those earnings estimates for the S&P 500 continue to move north. All right. The bad news, of course, is that the Federal Reserve is not going to be as friendly. We're not going to get as many cuts as we had hoped. Of more concern is what I see happening on the 10-year. So much of our credit is established off the 10-year rate. Think about it. Credit card rates are established often off what's happening with the 10-year. Certainly, your mortgage is established off of that. And so if 10-year rates remain high, and coming into the start of this week, as of Friday, which was a pretty negative day, you saw the 10-year, I think I saw it hit 462. And if it keeps edging higher and we start to get towards 5%, trust me, at 5%, we're going to be having a very different conversation about stocks. It's going to make it that much tougher. So we'll have to see what that looks like as the days, weeks, and months unfold. Nevertheless, it was a problem for this week. I think a lot of the selling that we got as a result of the Federal Reserve, I think it was a trigger, because what I saw really for this month was a tremendous amount of profit taking. Yes, there was the traditional year-end where you sell the losers to knock off some of the capital gains hit that you're going to have for when you report your taxes next year. But I saw a lot of insider selling that was quite large. You saw my article last week where I talked about AppLovin. That was $4 billion of insider sales. That wasn't small. Now, granted, there was one large institutional seller that was, I believe, KKR selling a pretty large block. But if you look at the share counts of a lot of the insiders who sold, there was 100,000 shares, 200, 300. That's serious money, especially when a stock is trading over $300. So when you have that much of your net worth tied up in a single security, uh, the tax bill doesn't matter. All that you want to do is lock that in. And I think a lot of players followed that lead. Hedge funds certainly did it. They're not as tax sensitive. Uh, I think there's, of course, endowments that may not have taxable considerations like you or I. I think the next wave of selling could happen in a couple of days. You could see some retail investors, portfolio managers like myself, advisors start to reposition, taking some gains in securities, uh, in stocks that they have greatly appreciated. Maybe they had them originally at a 2% position and now they're a 3% position. And when you have moves this big, it could easily do that. Just look at some of the numbers. Coming in to the start of this month, which has been pretty disruptive, the Russell 1000 had about 135 stocks up over 50%. A couple of dozen up over 100%, two over 500%, and I believe one, AppLovin, up over 700%. Those kind of gains don't go unnoticed, and it makes everybody, real trigger happy. So we're going to have to get through this disruptive period, the end of this year, the beginning of next year, and then we'll probably have a better idea of what the outlook for the markets as a whole is. Maybe I'm going to say 4 weeks. Everybody's going to talk about the first week of trading and what it means for the markets. That's one of those Wall Street axioms that works right up until the time that I use it. I don't know that I'm going to really pay that much homage. But let's just go back, to some of the basics. Just give me 1 second here. I'm going to pause the tape. All right, I want to shift the focus to individual stocks. This time of year, we tend to look back, what worked, what didn't, and what's next. I look at the sector, the sector performance over the last year, and you've got three sectors, fighting for last place: materials, energy, healthcare, all did quite poorly. Each of them had their own dynamic, but I wanted to focus on energy for a second because it's not the first time energy's come in last. If you think back to 2020, you couldn't get out of energy stocks, fast enough. In fact, it had come off a pretty horrible year at that point. Then, of course, Pfizer announced a vaccine. I don't want to go into that, but energy, went on a tear for the next couple of years because it has a lot of benefits. It's certainly a value play, generates a lot of free cash flow. But it's important right now because today we are still in the early stages of one of the most exciting technology shifts in a generation. That's, of course, artificial intelligence, AI. And the one thing we know about AI is we're going to need energy and lots of it. And we can look to a lot of energy sources out there. Certainly, everyone's excited about nuclear. Nuclear is going to certainly play a role. We saw what Microsoft did with 3 Mile Island. That's not going to be the last of it. You're going to have SMRs, which are small modular reactors. Exciting stuff, but it's all a few years down the road. Wind and solar, yeah, it can play a role, but it can't handle the base load. You need a power that is not intermittent. That means fossil fuel. And if you're going to use fossil fuel, why not choose the cleanest of fossil fuels, natural gas? And the good news is the United States is one of the leading producers of natural gas. And we can produce more. The other piece of news, of course, is political. We have a new administration coming in. The last administration, along with the climate lobby, did everything they could to kind of put the brakes on nat gas. I don't understand it because if you really care about the planet, you have to understand that wind and solar are not going to do it for a while. It's going to take time, and the world has to go on. And now you throw in artificial intelligence, and suddenly your needs are massive. As a matter of fact, when you look at what data centers are going to require over the next 3 years, it could be 74 to 132 gigawatts. That's equal to close to 12% of all electricity consumption in the United States. So we're going to need power, like I said, and lots of it. So if nat gas is going to play a role, we have to start to look for companies out there. Now, a name that's been on my screens for a while, and I just never pulled the trigger on it. I was focused elsewhere. Is a company called Antero Resources, symbol AR. I believe it's been in the news because David Tepper has been an investor. He's probably done quite well with it. David of course, runs Appaloosa, pretty notable investor with a pretty good track record. But when you look at the numbers, it says quite a bit. One, these are free cash flow machines. I would expect this year, Antero, just based on the numbers that I'm seeing, should generate about $800 million in free cash flow. That's off a $5 billion revenue run rate. That equates to about a 17% free cash flow yield, 13 times earnings. Pretty exciting stuff. Keep in mind, these are smaller companies, and their earnings tend to be lumpy, can often disappoint. You might consider a basket of securities like this. They are in the Utica Basin and the Marcellus Shale Basin, so they are definitely an Appalachia play, even though the company is headquartered in Denver, Colorado. It is an Appalachia play, where there's obviously a fair amount of nat gas. Hopefully, under a Trump administration, the permitting for these companies, and more importantly, the permitting for the needed pipelines and the transport for this will go as planned. Again, the outgoing administration did a lot to put the brakes on this industry, and hopefully that's going to get a lot better. One more stock I want to talk about is Expedia. I've talked about this in the past on various networks. We've all seen the travel demands that consumers have, put on the industry. We've seen what stocks like have done in airlines, cruise lines, and the one thing certain is the consumer seems to have a real appetite, and at least when it comes to getting out of the house. What I like about Expedia, and what's unique here, is this is a company that has the gross margins of a sexy software company, yet it trades with a market multiple that you would expect from a legacy retailer, 13 times forward earnings. So for me, as an analyst and as a portfolio manager, that's pretty attractive. Now, there is some fear about the advent of AI and how it could disrupt the industry, and I think they've addressed that. They've actually partnered with ChatGPT. I think that's, maybe a smart move on their part, and I believe you're already able to go on their site and have meaningful conversations about where you want to go next, and you're talking to some artificial intelligence. If it's not there yet, it's going to be there. It's going to be there quite soon. It trades at a very respectable multiple, 13 times forward earnings. So I like this one. I own this one. Antero I do not own yet, and I will likely pull the trigger on this right after the first of the year. I've got to sell some stuff to do that, and frankly, there's a fair amount of gains out there, so I'm going to have to wait a couple of days. That's all I've got for this week. I just wanted to get my talking points together, kind of set you up for the start of the week. I'll be back later in the week, probably with a full-blown podcast. Until then, be well. I'm David Nelson, and this is The Money Runner.